is to look on how the new tax act have already developed over the years in regards to capital allowances. One of the key things that you need to understand is that the capital allowances is normally granted instead of depreciation as a compensation for the loss of value of the assets repeatedly in the business to generate the taxable income. So rather than giving, I know previously you have been looking on how do you have to work with the depreciation. In taxation depreciation, as you can see in the first two topics we have done, it is normally treated as disallowable expense because it is not already considered by Tax Act. That is a very important aspect. And we are saying that the capital allowances that are normally recognized by the Tax Act, we normally have investment deductions, which we normally call it ID. We have industrial building deductions, which is IBD. And then we have wear and tear allowances, where we have to grant the non-manufactured machineries. We have farm work deductions, and we have mining allowances. And then later you shall be able to look on the shipping investment deductions. And when we look on the aspect of ID, which is the investment deduction, we say it is normally granted on non-manufacturing assets only once, currently at the rate of 50%. It is not the only ones it is not supposed to be used because it is normally granted once when the asset has already been purchased at the beginning of the period. That we are seeing at the rate of 50% in the first year. Then the subsequent years, we are going to be giving the residues. And that is where we are saying the residues of 25%. So in the year 2003, I think that information is not basically important for you. But we are saying that the processing machinery and other machinery associated with, for example, like water pump, packaging machine, conveyor belts, air cleaner, silencer, waste treatment plants, workshop machinery, generator, packaging machine, etc. Those are some of the machines which would be able to qualify for the ID. And we are saying that industrial building deduction, it is normally granted on manufacturing buildings and machineries. And we are saying that it is based on the reducing balance basis. And we are saying that currently at the rate of 10% per annum effective 2020. We know very well that before 2020, I think that information will not be much of use for you because it is above, it is best mostly used under the advanced level. So, but in NB, we are saying that in the building, if the NB, what are some of the items which normally qualifies for the IBD? We have the warehouse, staff clinic, staff quarters. We have canteen, gym, offices or administration block, showrooms, etc. And we are saying that in NB number 1, if the building is used for less than 1 year, IBD is apportioned accordingly. Number 2, we are saying in case of the building is used for given period before being transferred to another person, the qualified cost for the new owner remain the qualified cost of the previous owner. That information basically we shall be able to look at it when we are doing our questions there. But we are saying for the wear and tear, we remember before, I know that you might be having some material that you are using for some of the material that you are using for studying or for revision. You will find that IBD or WTS rather, it is normally granted on manufacturing machinery and equipment. And we are talking about effective 2020. WT only has 2 classes. We normally have class 1, where we are saying that it is at the rate of 25% per annum or reducing balance basis. We remember Kitambo, we used to have 4 classes for WTA. We used to have class 1, class 2, class 3, class 4, where class 1 was that 7.5%, class 2 was 30%, class 3 was 25%, class 4 was 12.5%. So the new changes which made or the new changes which were applied is that between the class 1, they were able to combine class 1 to class 3, and that is where we are saying that all the items which qualify there before for class 1 to 3 is qualifying for class 1 today. And we are saying it includes the self-propelling equipment that moves on earth. We are saying examples, we have Caterpillar tractor, bulldozers, compliant harvester, forklifts, lorry of 3 tons and above, a lorry below 3 tons, pickup, saloon car, tuk-tuk, motor vehicle. We have limo aircraft, delivery van, and staff bus, etc. And we are saying that in case of a saloon car, the qualifying cost is currently restricted at 3 million. So when the examiner is going to be giving you a question and you find the question is more above the cost of that asset is above 3 million, for instance, 6 million, 10 million and above, we are saying that the only taxable amount would be the restriction put in place by the Tax Act of 3 million. And that is one that we are going to be restricting when we are calculating for saloon cars during the disposal period, or when we are restricting that cost and we are calculating WTA for saloon cars. So the office electronic equipment also qualify for this class 1, and the electronic equipment that define the office, we have the computers, we have the photocopiers, printer, ITR scanner, calculator, duplicating machine, electronic paper shredder, websites, softwares, etc. And they all qualify for class 1. Class 2, we normally discuss about all these items which they don't qualify for class 1. And those are those assets. We basically have class 2 is all the assets which they don't qualify for class 1, they will be able to qualify for class 2. That is a simple elaboration of the same. And we understand very well that that information is well catered. We shall be able to look on the examples which qualify here. We have furniture and fittings. We have partitions for tax machines, neon signs, office carpets. We have wheelbarrows, bicycles, curtains, generator, water tank, loose tops, loose tools. Loose tools, we have spanners, pliers, and hammers. And also we normally have utensils, which are falling on that category. But the point that we are able to note is granted reducing balance, that is WTA. ID is granted 50% of the qualifying cost in the first year and 25% on a reducing balance basis on the residual amount. IBD is granted the rate of 10% on the reducing balance basis. IBD for showroom, retail shops. We normally do 10% test, by the way, for showrooms, retail shops, caretakers house, and admin blocks. We are saying no. The 10% test is when you normally find that the cost of these showrooms and showrooms and so on are normally included in the factory building. We shall be able to look on that once we do a question. I will just do one of the key questions that will be able to define everything in regards to capital allowances. Now, we are saying that they are normally granted the rate of 10% on reducing balance basis, but we are saying IBD for showroom, retail shops, caretakers house, and administration blocks are granted the rate of 25% on reducing balance basis. So that is the key. That is the key. Those are the things that we have to be looking at. And I will be able to look on the questions that already will be assisting us in the computations. So I have just said that let us do an illustration which will be assisting us in this computational understanding better about the capital allowances. And one of the good questions that I wanted us to do is on May 2016, question 4B. May 2016, you can be able to check there. May 2016, question 4B. May 2016, question 4B. We are looking for public finance and taxation. We have a good question here, and you can be able to read it. Nafaka Millers, just read this question.
Nafaka Millers Limited is a maize and wheat flour milling company. The company started its operations on 5th January after incurring the following expenditure: cost of land, furniture and fittings, factory building, packing machine, digital weighing scale, processing machine, tractor, computers, mobile phones, and then we have combined harvester. Additional information: the company constructed the following structures from the year which were utilized from 1st September 2015. Sports pavilion 624,000, labor quarters 1,200,000, recreation facility for 80,000, factory extension 960,000. The company disposed of 2 computers at 330,000 shillings each on 1st August 2015. The cost of processing machines include the installation cost of 120,000. Required capital allowances due to Nafaka Millers Limited for the year ended 31st December 2015.
Very good, very good. Because now the first thing is just an understanding of what normally qualifies. Yeah, that is very key. You need to be knowing which asset is qualifying for which asset is qualifying for which class, and that is why I have shared those notes with you, so that you can be able to know that certain asset is qualifying for capital allowances, and what are the rates which are being put out there by the commissioner. Now, I just want to be able to solve this question. It's a good question, given a lot of information there. So let me share my board here. So the question is, Nafaka Millers, you know that to your level, the examiner normally gives you a mark when you write the title. So in this case, we are talking about Nafaka Millers Limited. Nafaka Millers Limited. We are discussed about which year we're computing our capital allowances, which is very important.
December 2015.
No. The examiner ameuliza swali ya lini. So it is 2015, thank you. It is 2015 capital allowances. Capital allowance computation. Capital allowance computations in that manner. And we have said the first thing that we want to look on the capital allowance is the assets which are qualifying for ID. So let us start with number 1, investment deductions. And when I'm looking for investment deductions, a minute, please. 1 minute, please.
Okay.
So let us continue. The capital allowance is given. I just want to look on the items which are qualifying or qualifies for capital allowances. I just want to tell you that when the examiner is putting the cost of land there for the computation of the capital allowances, it means that, but what you need to understand is that the land does not qualify for any capital allowances, and therefore, hiyo amekuwekea hapo is just confusing you. Now we just need to group these items or these assets. So this is how you normally do it. We normally look on the items. We normally look on the qualifying costs. We have to be looking on the IBD rates. And then we have IBD amount. So we have said that the ID is normally granted to home manufacturing, or it is normally granted to what? On the manufacturing assets, and that is what we are looking at. So I look on the cost of land. It does not qualify for any capital allowance. We have the furniture and fittings, that is WTA. But I can see the examiners already put you there. Factory buildings. Factory buildings qualify for ID. So the factory building costs, it is 4.2 million. 4.2 million. Today, I remember during these days, the rate was 100%. Today, we are discussing about 50% in the first year. Remember, these assets were purchased during the current year, right? So these assets were purchased now, this current period. So in this scenario, the 50% is normally granted once at the beginning of the period. Then the subsequent years, we are going to be granting what? We are going to be granting 25% on the residue. So this is 2,100,000. That is the IBD amount. After the factory building, I can see we have packaging machine, which qualifies as part of the manufacturing asset. So you put here packaging machine. So the packaging machine, it is costing us how much? 960,000. At 50%, this is around 480,000. 480,000. We have digital weighing scale, that is WTA, but we have processing machine given. Processing machine. We are given at what rate? The processing machine is given at the qualifying cost is 540,000. The rate is 50%. The rate is 50%. So this is, it means it is 270,000. 270,000. From there, we have the tractor, that is WTA, computers, mobile phones, but we have combined harvester, which we shall be able to factorize later. Now, down there in additional information, I've been told the company constructed the following structures during the year which were utilized on the 1st September 2015. We have the sport pavilion, we have labor quarters, those are IBD. We have recreation facility, that is IBD. But we have factory extension. The question that I know it is in your mind is, but these items were purchased during the year, right? Kama hii imekuwa constructed and put in use on September 2015. So are we adjusting for dates? No, I'd say in the ID, we don't adjust for the period the asset is being put in use. You grant at annual rates, which is 50%. So this is equivalent to 480,000. 480. So when I look on that question, there is no any other item which is qualifying or qualifies for the investment deductions. So what I need to do is just get my IBD amount. IBD amount. How much is this? What is our summation there? What are the summations there?
330.
3330.
Yes.
Very good. 3330,000. I think you are seeing my board very clearly.
Yes.
Good. Now, that is how you normally calculate. That is the way you calculate the investment deduction. Let us look on the other capital allowance. The other capital allowance of ours, we have the other capital allowance, we have number 2. You look on the industrial building deductions. And that is IBD. And in IBD, I have already given you certain costs. We have given you certain costs, certain assets which are qualifying for the IBD. So here, look on the item. Here, we look on the qualifying costs. Kama tuko na residue brought down, tunaweka hapa. Residue brought down, right? Then we have the rates. We have the IBD rates. We normally have IBD amounts. And then we normally calculate residue carried down. Residue carried down. We normally do that. Now, I just want us to look on items which are qualified for the industrial building deductions from the question given by the examiner. Now, number one, we look on the additional information. We have the sport pavilion. Sport pavilion. The qualified cost given there by this examiner is 624,000. We don't have the residue brought down, but there is only statement which I want to make here. I say for the industrial building deductions, adjust the qualified cost of the assets based on the time they are put into use. They are being put into use. So that is one important aspect. So the sport pavilion, we have said, it is normally granted at the rate of 10%. So the IBD is 10%. So when you are calculating your IBD amount, this is what you normally do. I will just come here and I say 624,000. Remember, this rate is annually. The asset was put into use, right, from September. Mwaka yetu inaisha December. So on account, how many months? September, October, November, December. Are we discussing about 4 months? You say 4 over 12. 4 over 12. How much it is? How much it is?
2,800.
2,800. 2,800 or 400?
800.
Are they 4 or 5 months? September,
October,
November, December. 4 months, right?
4 months, yes.
A third of these. This is 2,208. Sawa, yes. 2,800. 2,800. So it means that when you look on the residue carried down, kama hapa tungekuwa na residue brought down, ningekuja nichukue hii figure minus the IBD amount. But because we don't have, I will take 624,000 minus 2,800. What is the difference?
$603,200.
603,200. Very good. 603,200. Then we have the other one is labor quarters. Labor quarters. So labor quarters here ni ngapi? Labor quarters. The examiner has given you 1.2 million. Hatuna hapo 10%, right? 10%. So IBD amount yetu ni ngapi? How much?
120,000.
120. Why? Hiyo ni uongo. Si una just pia. It was put into use on September.
40,000.
40,000. Very good. So here's 40,000. Residue carried down. Residue carried down. Can I see 1160,000?
Yes.
Then after the labor quarters, we have recreation facility. Our recreation facility is how much? 480. Let's dash 10%. 10%. How much it is?
16,000.
Good, 16,000. 16,000. Yeah. What is the residue carried down?
464.
464,000. 464,000. IBD amount yako ni ngapi? I can see it is 76,800. 76,800. Unaelewa mpaka hapo? Now the other one is WTA. Wacha tuende kwa WTA sasa. Tuende tufanye WTA. Let us do our WTA. Number 3, we do WTA, wear and tear allowance. Wear and tear allowance. And in this case, we say it is a wear and tear allowance. We have said we normally have 2 classes. We have class 1, right, at the rate of 25%. And then we have class 2 at the rate of 10%.
10%.
Very good. So, kama kuna assets already which have the written down value, hapo unaanzanga na written down value at the beginning of the year. For example, you can talk about first, is it 2015? Unaeka hapo. Then, the assets that you're going to be buying during the year, we normally call them additions. Additions. Now, let me start the question from up there. I've been given, the first one is furniture and fittings. Furniture and fittings. Furniture and fittings qualify for class 2. Class 2. What is the amount? 250,000. Unaeka hapa 250. Right? Then I factory packaging machine, digital weighing scale. So we have weighing scale. So weighing scale inaenda wapi? Weighing scale qualify for which class? Class 2. 60,000. 60,000 there. We have processing tractor. Tractor qualify for?
Class 1.
Class 1, very good. At the which I could see there, it is 2.4 million. 2.4 million. We have computers qualify for which class?
Class 2.
Class 1, 620. Follow those notes very well. We have mobile phones. Mobile phones qualify for which class? Mobile phones, class 2 mobile phone, 140,000. Then we have combined harvester. Combined harvester is how much? 1.8, qualify for class 1. Qualify for class 1. Now, we are being given a lot of information there. I could see there is an additional information which I did not explain, but it doesn't affect anything. In note number 3, the cost of processing machine includes the installation. The total cost of the asset, niyo cost yake umenunua na installation, that is okay. So it doesn't have any problem. That is no sense. But I can see there is something called disposal in note number 2. The company disposed of 2 computers at 30 each. So let us factor our disposal. We disposed computers.
Computer.
2 times 30,000. 2 times 30. This is 60,000. We subtract there. Nothing else. So let me get the qualified cost for each class. The qualified cost for each class. The qualified cost. The qualified class 1 ni ngapi?
2,600.
Sorry?
2,600,000. 2.6 million.
2.6.
Yes, million.
That is wrong. Tractor is 2.4, 620, 1.8 minus 60,000. How much are we getting there? But this I know is 450. The first one?
47,60,000.
47?
60,000.
47, 60,000. Then calculate your WTS. Remember the rate for the 47, 16, and 25? This I know is 45,000. What is the written down values? This is you when you're being ngapi. So the written down values at that first mwezi wa 12 2015 ngapi? The written down values. Hapo umeniambia ni ngapi? 25% of
7.
Sorry?
190.
190,000. Namna hiyo?
Yes. Yes.
Haya. Tupe the written down values.
35,70,000.
Sorry?
35,70,000.
35,70,000.
And 5,000.
405,000. 405,000. 405,000. Have you understood?
Yes.
Let us do another question which includes saloon car. Before I give you a lot of assignments. So angalia November 2015. November 2015 there. You understand the two questions, then no question of the capital allowances inapaswa kuwa inakupea shida. So let us look for November 2015. November 2015, it should be question 4C. November 2015, question 4C. November 2015, question 4C. I know that you have read questions for, or the notes for, the questions for, not the question, but the notes for public finance.
Yes.
Good. Now, I want you to read the question. Let's read the question. Can you see my question?
Yes, I'm trying kidogo. Pesa Limited commenced manufacturing on 1st January 2014 after incurring the following capital expenditure: factory building 8 million, processing machinery
Just go
2.4
straight to the
million.
additional information, straight.
Factory buildings include dwelling house and a commercial building comprising of an office of 1.2, a shop of 800,000 shillings, and a showroom. Processing machinery excludes an interest on loan of 240,000 shillings paid for a loan of 2 million used to acquire the machinery and installation costs amounting to 6,000 shillings. The saloon car was disposed of on 1st December 2014 for 1.8 million. A staff canteen constructed during the year at a cost of 840,000 was put into use on September 2014. A section of workers' quarters burned down by fire had been renovated at a cost of 1.5 million. The remaining section, which was not affected by the fire, had been valued by an insurance company at 1 million. The workers' quarters were reoccupied on 1st October 2014. Then, yes, nimemaliza.
Good. So what I can be able to look at it there, the examiner is asking you to calculate the capital allowance due to Pesa Limited for the year ended at 1st December 2014. When I look on the factory building there, we have to be doing something called the 10% test to know whether those items normally are qualifying for capital allowance or not, qualifying for ID or IBD. Now, let me check something that I want to add there. So let me see a minute, please. Let me calculate something there. So based on our note, there is something that we discuss about the 10% tests. We said it comprises what?
Ati?
Now, I know there is an area we were discussing about the 10% tests.
Yes.
So, tulikuwa tunasema aje?
Tunaangalia. Tuna include the total costs over the over the non-qualifying cost times 100.
So the first thing that we have to be looking is the 10% tests. Let me show you how we are going to be doing it. The 10% test. So the 10% test, we have to be looking on those commercial buildings where they are qualifying for ID or IPT. So it will be 10% tests. So in this case, we are going to be taking the cost, the qualifying cost for both, for all of them, sorry. We have number one. Number one, we have a office comprised of an office of 1.2 million plus 800 plus 600. And then we divide by the factory building cost, which is 8,000, right? Times 100%. How much is it? How much is that? How much is that?
32.5%.
That's 2.5%. That 2.5%. So we say if the proportion or if the 10% percent test, if the percentage, sorry, is above 10%, right? Subtract the commercial buildings, the more commercial buildings from factory building, and grant them IBD, and grant them IBD. That is how we are supposed to be doing it. So let us do this. Let us start our question now, because we know the cost is above that. So the factory building has to be subtracted, those costs. I can see also the factory building is having, we are having a dwelling house, which is also being subtracted because it will qualify for IBD. So this is what you have to do. This is what we are going to be doing. So here we have the items. We have the qualifying costs. We have the ID at the rate of 50%. Now, let's start with the factory building. Factory building. So we have said you take 8,000. Let me reduce to zeros here. We have ID amount. So 8,000 minus 1180 for dwelling house, minus 1,200, minus 600, minus 800. What is the cost for factory building? How much?
4220.
4220,000. Very good. So 4220, yet is 50%. So I can see 202,110. Sindio?
Yes.
Now the processing machinery is another one which is qualifying for capital for ID. So in this case we say processing machinery. When you look on the processing machinery, note number 2, you are being told, processing machinery excludes an interest on loan of 240,000 paid on loan of 2 million used to acquire the machinery and the installation. The only cost that we are supposed to be adding to that cost of 2.4, it is 60,000, the installation cost. This is 2460 at 50%. This is 2130. Right, 2130. We have the saloon car. We know very well qualify for WTA, neon advertising W, computers WTA, delivery van WTA. We have water tank. Water tank qualifying for what? For WTA. Computer software WTA, lorries, all that qualify for WTA. But we are being told in note number 3, that is the cost of the saloon car, no problem. Note number 4, it doesn't have any issue. But we are being told in note number 5, right? We are being told a section of workers' quarters burned down by fire and has been renovated. So the remaining section which has not been affected in the blah, blah, we have the insurance. But do we have anything? Anything? Just look in there. Let me check. There is something I skipped there, which is called water pump. water pump, which was costing 40,000, 50%, and this is 20. Nothing else which is qualifying for ID. So give me the ID amount. Sorry?
Processing means 1230.
How much is this? Is it 42? Just confirm. Is it 4260?
Yeah.
Sorry?
Co-processing, the ID amount is 1230.
Sorry?
1230.
1230.
Yes.
Okay. Yes, it is 1230. Sorry. So what is the total here?
3360.
36?
3360.
3360. 3360. 3360. Are we okay to that point?
Yes.
That is okay. Let us go now to not number two, not number two, but the other capital allowance. We discuss about IBD. So here we discuss about IBD, which is the second capital allowance we have to compute. I said you look on the items, qualifying costs. We have the residue brought down. We have the IBD rates, right? Do we have the IBD amounts? Then we have residue carried down. Residue carried down. So we start with the first one, and we have to be looking on the deduction that we have already made. So already I can start with the dwelling house. So let me start with the dwelling house. Dwelling house, we say the qualified cost is 1180,000. It does not have any residue. But what is the IBD rate? The rate for the dwelling house will be how much? 10%, right? 10%. Are we going to be adjusting for the period which was not, it has been in existence for the whole year? So this is 118,000, right? What is the residue carried down? What is our residue carried down?
1062,000.
Excuse me? 12?
1062,000.
When you have something like that.
Yes.
The second one we have the commercial buildings, which comprise of the office. So our office is how much? Costing 1.2 million. The rate for these commercial buildings, we said is how much? The rate for these commercial houses, it is 25%. So 1,200 divided by 4, which we get 300,000. Are we together at that point?
Yes.
Sorry?
Yes.
So this is 900,000. Senior?
Yes.
Now, after the office, we have, the examiner was able to tell us there is a shop. Shop for how much? 800,000. There we have dash. The rate we have said is 25%. I think here 200,000. And there is 600,000. Together?
Yes.
We have the showroom. Showroom is 600,000. 25%. Right? This is 150. So the difference here is 450,000. Any other item which is qualifying for IBD, yes. In note number 5, I've been told that a section of workers quarters burned down by fire and has been renovated as a cost of 1.5 million. Right? So here we talk about the staff quarters. 1.5 million. The rate is 10%, right? The rate for the staff quarters is 10%. So itakuwa ngapi? Hii ni ngapi? IBD amount? Hey, Barbara?
Yes.
How much is this?
150,000.
Inapata 375,000. That's 7,500. Is it like that? Look on the time the staff quota was put in use. It was on 1st October. So October, November, and December. We have already adjusted here. Sindio?
Yes.
That's 7,500. So when you take that, you'll be able to get that. So 1,500 minus that 7.5, you're getting 1,462, 500. Then after the staff quarters, we have what? Was it the staff canteen constructed to bring? We have been told in note number 4, a staff canteen. A staff canteen constructed during the year at a cost of 800 was put in use on September. So here we talk about the staff canteen. Staff canteen, we have been told it's 840,000 dash 10%. How much is the IBD amount? September, October, November, December, those are 4 months. So 840 divided by 3 times 0.1. Are you getting 28,000?
Yes, 20,000.
So 840 minus answer, we are getting 812,000. So what is our IBD amount here? What is our IBD amount total? How much are you getting? Are you getting something close to that?
$833,500.
Good. It is 833,500. So let us do the last one, which has been called WTA. Let us do WTA. Let us do our WTA. So in this case, we say number 3, wear and tear allowance, right? Wear and tear allowances. So in this case, the wear and tear allowances, we are going to be looking on the classes that we are having today. We say we have class 1 at 25%. Then we have class 2 at the rate of 10%. So we said we can start with the written down values if they are there at the beginning of the year. So Atuna. Then we have additions. So we have processing machinery. I can see we have saloon car, right? So we start with my saloon car. Saloon car cost, which is given there, it is 2.8. So that is less than 3 million. So it doesn't have problems. So we are going to be dealing with 2.8. We normally restrict when it is above 3 million. Then the other one is, we have neon sign. Barbara, nafikiri niko na wewe hapa. So the neon sign is 48, qualified for class 2. Neon sign. We have computers which are qualifying for class 1, 150,000. up on the dash. Then we have delivery van. Delivery van, we are being told it is 960,000. 960,000, right? We have furnitures and fittings. Furnitures and fittings are how much? 200,000 class 2. Right? Then we have water tank. Water tank, which is qualified for which class?
Class 2.
960. Then we have computer software given there. Computer software given, it is 120 class 1. Then we have lorry, 3 tons. We used to separate kitambo, lakini saa hizi zote, they qualify for one class, so there is no any problem. Yes, 2750. You put their dash, 2750. You put that dash, right? But when I look at number 3, we are being told there is a disposal. Disposal of a saloon car. Disposal of a saloon car. So we are being told that a saloon car was disposed at 1.8 million, right? 1.8 million. So how are we going to be calculating this? It will be 1.8 with the disposal cost. We divide by, we used to do like what? Let me check a minute.
Okay.
Let me check 1 minute. It will just be direct. It will be 18. Here we subtract 18 because we have not restricted. We have not restricted. So the time we are restricting, when you are calculating the cost of the disposal of the saloon car, unakujanga hapo unasema to get that value that you have to the saloon car disposal cost. So you can take the proceeds. Let me write it here. So to calculate the disposal of a saloon car, when you are restricting, you normally take the car proceeds. You divide by the original cost. Then you multiply by the restriction amount, value. In our case today, the restriction is 3 million. Sasa, on our saloon car here, we are not restricted because we are not calculating this kind of a process because there is no restriction values put in. So remember, the cost is less. We normally restrict when it's above 3 million. So you just work on it directly. So what is the qualifying cost for the two classes? Qualifying cost. Let me do class 1. I got here 4980.
1640.
1640. Right? Then deduct your WTA for the year. So I myself, I multiply by 0.112, 0.25, sorry. I'm getting 1245,000. So the written down values at the end inakuwa ngapi? So on my case here, I take 4980 minus my answer, and I'm going to be getting that 735,000. Haya, twende kwako sasa. How much is this?
Hapo kwa
sorry?
neon sign, is it 48, 4.8 or 48?
Neon sign. Neon advertising sign, I can see 48,000.
Okay, then the qualifying cost is 1208.
1248.
Yes. And then
10% I will be get 1,800. How much is this?
1087 200.
1087 200. 1087 200. Understood? Understood?
Yes.
Nothing else you need to understand there in terms of the WTA. I think that is already done, dusted. Nothing else we need to be able to learn about. The capital allowance is more than that, add to a level. That is done and dusted. So I just want us to look on the VAT. The VAT. Just want us to look on the VAT. So I know very well that these are a lot of discussions we have been hearing all around about the increase in the commodities, increase in the products, and all of us, we are arguing about how the life has been difficult. And that being said and done, the life already, we normally pay taxes so that we can be able to depend on our own. The only challenge that we normally have when we are discussing the aspect of the utilization of the taxes, which are normally levied on the products which the citizens are using, we normally ask ourselves, how do we normally use our VAT? But before I elaborate that further, we have to be looking on what is the definition of the VAT. And it is charged on the supplies. Everything that I'm going to be selling, we are saying that every product which I will be able to sell, which already it has a value added, then it means that we are going to be deducting it or increasing the price of the commodities. Let me come again. For example, if I'm doing a production and the production which I'm doing, I'm producing cement, and the cement which I will be able to produce, I just say that the cement that I'm going to be, I have to process. Every time I decide to process, then it means there is an addition of value. So that is why we are talking about, it is a tax on spending which is collected by business agents as agents of the government and passed on to the government. So the VAT is a development from the sales tax, which was abolished in 1989. And we can see was reintroduced in 2007 as a turnover tax. VAT is applicable to goods and services mainly in the business area. and it is payable where the taxable goods or services are supplied in Kenya by taxable persons and in the course of the furtherance of the business of that person. So the VAT is a multi-stage tax that is deducted at every stage of handling goods and or services and passed on to the government. So the basic law governing VAT are contained in Cap 476. How VAT works, we are saying once you have registered, you will be required to charge, collect, and account for VAT on your taxable supplies and remit to the the tax to the Commission of VAT. We really understand very well that the VAT, whenever you make a taxable supply, the supply is your output and the tax you charge in your output tax. If you purchase taxable supplies for furtherance of your business, the supply in your input is your input and the taxable tax you pay is your input tax. You should subtract the input tax attributable to taxable supplies from your output tax and pay the difference to the Commission of VAT. If your input is greater than the output tax, you should carry forward the difference as a credit to your next VAT return. That is the thing that we are looking at. Now, how do the business normally register? We are saying that the company registration normally applies to any person who is the course of his business has applied taxable goods or services or expect to carry or to supply taxable goods or taxable services of both, the value of which is 5 million. So they or more in the period of 12 months. So the question that we are supposed to be asking ourselves, what about the people who their turnover tax is not more than 5 million? The turnover is not more than 5 million. We say that those people should already register for turnover tax, TOT, for payment of taxes. Any person who meets the above condition is a taxable person and should within 30 days of becoming a taxable person apply for registration. So we are looking on the voluntary registration is permissible under the law, but it is granted in the discretion of the commissioner. So the deregistration from the VAT should be done within a period of 12 months because you normally find that your amount does not exceed 5 million. And that is why I said you have to factor that. So change affecting registration, I will be able to share these notes with you. You look at those information given there. Back at the duties, what are the supply of goods and services, time of supply, and the tax point. We say VAT becomes due and payable at the time when the goods and services are supplied to the commissioner or to the purchaser, sorry. An invoice is issued in respect to the supply. But you know, right now, as an accountant, we are under a lot of pressure because we hear very well that there must be some changes which are taking place. And the commissioner is requiring us to make an organization or to advise our organization to comply. So we know very well that we are having a lot of challenges and accountants to ensure that the businesses are not caught by the KRA because they already set the deadlines for the change of the ETR machines, which already KRA wants some teams which already are configured and which are meeting the requirements put in place. So those are the things that we know very well that as a VAT is already concerned are the few things that we have to be put in consideration. But there must be some few areas in where we are going to be looking on the aspect of restriction. And when we are going to be restricting the VATs, we have to be looking on what are the criteria normally followed when you want to restrict VAT. And the restriction which we normally follow when we are restricting the VAT, we are saying that when you look on my notes there, we are saying very well that a taxable person who is a retailer and mainly supply taxable goods is required to quote or label a price that is inclusive of VAT. So we are saying the VAT is equal to the value inclusive of VAT times rate of the VAT, you divide by 100%, and then we have the rate of the VAT, which is 116%. You remember there is a time in which it is 14%. So basically I have to be looking on how the examiner is going to be setting the questions. On the aspect of the qualifying cost, because that is the area that we have to focus our attention into, there is an area we are going to be talking about the values or the amount. The qualifying cost should be exclusive of the VAT. And that is where we are saying we have to subtract the VAT from those respective grounds. Now, the examiner also normally wants you to calculate the VAT account. I will be able to show you that during the time that we have to be looking on the VAT, there are certain things that we have to be already, because the examiner may ask for VAT account, we normally use the T account. So that is one thing that we are going to be looking at. But we have three types of rate which we are facing today. For zero rated supplies, goods listed in the second schedule of the VAT Act, that is during the exportation of goods and services, goods supplied to EPZ, LPG, privileged persons and public bodies. That is the thing that we are discussing there. 16% is a general rate for the other goods and services. Sometimes 2020, 2021, some part of the year there, it was 14%. So you have to check the mind of the examiner when you're kuchezea hapo. Then we have to look on note number 3. We are talking about the 8%. The petroleum oils obtained from by terminals, motor spirits, etc., diesel, supero, aviation spirit, and so on. So the types of the supplies we normally have exempt. There is an area I was teaching you about. I talked about restriction. Every time you see a question is having exempt supplies, you have to restrict. How? I will be able to show you. So these are the business transactions on which VAT is not chargeable. They are not taxable supplies. So the VAT of exempt supplies will be deregistered and in determining the taxable turnover and the need to register for VAT. So what are some of the examples of exempt services? The financial, insurance, the supply of education services, medical, agricultural, burial, cremation services, transportation. There are a lot of things there that you can be able to look at. So the exempt of the goods, some of the things which are normally exempt from tax, we look on the fruits, whether dried or not. But do you know that the cocktail and the cocktail passions and so on they attract VAT? Why? Because already they are processed and there is an addition of value. There is value added part. So we have to be looking on those things. We have milk and cream, birds, eggs, whether in shell or not. We have fish and other animals products, vegetables, grains, wood and coffins, use of postage, revenue or similar stamp, rocket launchers and the military weapons, water, etc. We also normally have zero rated. Zero rated, we are looking on these are the business transactions on which VAT is charged the rate of 0%. Although no tax is payable on such items, they are treated as taxable supply in all respects because they attract 0%. We are saying that the examples of zero rated, there are very many there. I have given you examples and we shall be able, like exports. Then we have taxable supplies. These are the things that we are going to be putting in place. Then we normally have special rated supplies, which we are talking about Petroleum oil, 8%. All of these qualify for different rates as defined by the VAT Act. So when we are discussing about the restriction, because these are things that I wanted you to understand, we are saying that that there is no output tax for exempt supplies, hence no deduction of input tax on exempt supplies. We are saying zero rated supplies are taxable, but the output tax is zero, and therefore there is a related output tax. Hence, the input tax on the zero rated supplies is deducted. For exempt supplies, these are not taxable supplies, and there is no output tax. Therefore, none of the input tax on exempt supplies is deductible. Where a person makes all types of supplies, the deductible input tax shall be limited to the proportion of output tax that bears on the taxable supplies. But hii story ni mingi sana. Every time you see we have what? We have exempt. We have to work on the restriction. I will be able to teach you how to do it. All of these notes are part of you to ujielimishe and so on. So I just want us to look on illustration now. Illustration will be very important for us. And let me start with November 2015, question 5. I think it is C. Question 5C. Question number 5C. Question number 5C. Question number 5C. So let us move on as I try to teach you how to do the VAT. So read the question. Hello?
Yes, the following transactions were extracted from the books of Infolink Communications Limited
Hello?
on credit worth 1,800 million, purchased office furniture for 720,000 shillings, Excel Furniture Marts. On third, sold goods worth 860,000 to Kenlink Communications Limited on credit. Fourth, purchased spare parts for motor vehicles worth 230 shillings. 5th April, returned office furniture worth 180 shillings to Excel Furniture Mart and was issued with a debit note of the same amount. 6th April, goods worth 120,000 shillings were found to be defective and Kenlink Communications Limited returned them. 9th April, we have purchased goods worth 2.4 million from Japan, exclusive of import duty of 15% and VAT at the rate of 16%. On 10th April, sold goods for cash worth 3.2 M. 12th April, exported goods worth 4.2 M to Annex Enterprises Limited in Uganda. 16th April, paid catering expenses worth 160,000 shillings. 18th April, imported goods worth 1.6 million from India exclusive of import duty of 25% and VAT at the rate of 16%. 20th April, renovated the existing buildings at a cost of 800,000 shillings. 22nd April, paid rent and rates amounting to 490,000 shillings. 24th April, exported goods worth 2.4 million to South Africa. 28th April, sold goods worth 980 shillings to Vista Communications Limited in cash. And then 29th April, hired a taxi to transport staff and paid 9,000 shillings. 30th April, the following expenses for the month of April 2015. Water bill, we have salaries, telephone bill, and electricity bill. The above transactions are stated inclusive of VAT at the rate of 16% where applicable and unless otherwise stated. Required, the VAT payable by or refundable to Infolink Communications Limited for the month of April 2015.
So let me kill two birds with one stone. I'll be able to do this question using a T account, a VAT account. When the examiner is asking for a VAT account, I'll be able to show you how and what does that mean. So I just want to solve it, but I will be able to use a VAT account. So this is what you normally do. Remember, we are doing November 2015. November 2015. Question number 5C. So in this question, I just want to do a VAT account. Normally looking like this. This is my VAT account, right? So in this case, you have to be factoring what qualifies for which side. So if it is my parties, I put them here. So we talk about inputs, and here we discuss about outputs. So we have to be looking on the items. We have the qualifying costs. These qualifying costs, have you seen? These qualifying costs should be exclusive of VAT. Should be exclusive of the VAT. But now I just want to go straight by doing my question directly. Directly. So in these scenarios, what you need to be able to understand is what is fitting where. I just want to start with the first date, right? The first day. So on the first day, what happened? On 2nd April, we purchased goods from Mambo Enterprise Limited. So there is a purchase there. So I say there is purchases at standard rate. Purchases at standard rate. So we are being told, let me limit to 1800. Limit to those zeros. Then I multiply directly by 16 over 160. Why? Because the examiner down there is saying, the examiner is saying this, the above transactions are inclusive. So that is why I'm taking 16. Why? Because already the 1800,000 is equal to 116. You ask yourself, what about 16? What about 16? How much are we getting here? We are getting how much?
248.27.
So here we are talking about Kenya shillings into zeros. So you have gotten 248.27. Yeah. Okay. You have been told on second purchase of furniture. So there is a purchase of furniture. Purchase of furniture of 7, but we have been told 720 from Excel Furniture Mart. So it will be 720 times 16 over 116. How much is this?
99.31.
99.31. Next, sold goods worth 850 to Kenlink Communications. So here we discuss about sales to Kenlink, right? So the sales were worth how much? 860 times 16 over 116. So 860 times 16 over 116. Is it 118?
Yes.
162. The next day, we are being sold goods worth, not number 4, purchase spare parts for motor vehicles worth 230, right? So, purchases of spare parts. So, the spare parts will be 230 over 116. 31.72. Are you together?
Yes.
Number 5, not number 5, return office furniture worth 180 to Excel Furniture Mart and was issued with a debit on the same amount. So that is debit note. Receipt returned office furniture. It is returned outwards. What we are supposed to be looking here is the debit. Debit not received. Right. there was a return of the office furniture of 180 to Excel Furniture Mart and was issued with a credit note of the same amount. So here, let me talk about the return outwards. So in a manage, it will be able to reduce this VAT. So in this case, we are discussing about 180 times 16 over 116. 180 times 16 over 116. How much are you getting?
24.83.
24.83. Then note number 6, we have been told goods worth 120 were found to be defective and Kenling Limited returned them. Right? Here we are discussing about return inward. And it is coming from Kenling. So it will be, how much are we told here? Goods worth 120. So it will be 120 times 16 over 116. 120 times 16 divided by 116. Are you traveling? Hello, Barbara?
Yes.
Are you traveling?
No.
Sorry?
No, I'm not.
I can't get you.
Oh, no. 16.
Now let us look on the next. We are talking about, or not date 9. He purchased good worth 2.4 million from Japan, exclusive of import duty of 15% and VAT at the rate of 16%. So how are we going to be working on it? I discuss about imports, and you understand that the total cost will be inclusive of the import duty. So it will be 2.4 million times bit of the import duty is 15%, and this amount was exclusive of the VAT. Just charge it directly. Just charge it directly. So this should be 115, by the way, because it is the 100 which are exclusive plus 15, the proportion that we were looking, it should be 115%. So 2400 times 1.15 times 0.16. I'm getting 441,600. 441.6. 441.6. The other one we are being told, anything else? We are being told sold goods for cash worth 3.2 billion. So here we talk about sales, which are cash, right? Which are amounted to 3,200. So it will be 3,200 times 16 over 116. So 3,200 times 16 divided by 116. We remain with 441 to pay, 0.38. 441.38. Exported goods worth 4.2 million to annex, right? So we say the exports affect our outputs. So here we say exports worth 4,200, and we say they are zero rated. So here it is 0. Exports are zero rated. Next, you are being told exported goods worth that. Paid catering expenses worth 160,000. Catering before was prohibited. Catering services. Today, they are charging 2%. So the catering services for hours is 160,000 times 2%. And this is equivalent to 3.2. 3.2. Next, we are talking about the import goods worth 1.6 from India, exclusive of the import duty. So the same scenario, imports, the India. So what's 1.6? So it will be 1.6 times 1.15 times 16%. This is 294.4, 2.4.4. Then you are being told on 20th, they renovated the existing building at 800. And then we talk about the renovation, which is 800 times 16 over 116. 800 times 16, we divide by 116. It is 110.34. Are you there?
Yes.
Paid rented rates amounted to 490,000. Rented rates. And we are being told that the rent and rates given there were 490 times 16 over 116. So 490 times 16, you divide by 116, you're getting 67.59. Then we have exported goods worth 2.4 million to South Africa. So hapo unaniambia exports to SA worth 2.4 million times 0%, and we get 0. And then we have sold goods worth 980 to Vista Communication Limited in cash. So here we have sales to Vista. So the sales will be amounting 980. So it is 980 times 16, you divide by 116. 135.17. Remember, we were discussing about the inputs to Vista, that is date number date 28. Then on 29, we hired a taxi to transport staff, paid at 9,000. So here you talk about taxi. So it is 9 times 16 over 116. 9 times 16 over 116 is how much?
$1.24.
Sorry?
1.24.
1.24 goods. Then from there we are being told on date number 30th, he paid the expenses for the following. We are being told about the water bill. The water bill, we have the salaries and wages. We have telephone bill. So here we have the telephone bill. Telephone bill for hours is how much? 48 times 16 over 116. Times 16 over 116.
6.62.
Sorry?
6.62.
6.62. Then we have electricity bill. Electricity bill amounting to 180 times 16 over 116.
24.83.
Sorry?
24.83.
24.83. So the water, the reason is where you see the water there, the examiner has not specified whether it is a mineral water or is the water ya kanjua, tujui that water ni gani. But on the aspect of the water, ile unaenda kununua supermarket is normally have it. Because already it is the added value, it has a value added. So that is okay for maji ya kanju. Wakati utaiona maji ya bottled water, it attracts VAT. So when you see it in an exam, just know it's part of your inputs. Salaries and wages, they don't attract VAT, but that is where you see I have not factored them. So in this case, let us get the summation. Let us balance and we see where the VAT refundable, because here we are supposed to be having the VAT refundable. VAT refundable should be there. Then here we are supposed to be talking about the VAT payable. The VAT payable. So let me add the inputs. The inputs. Let me add my inputs, and we have 248.27 plus 99.31 plus 31.72 plus 24.83 plus 441.6 plus 3.2 plus 294.4 plus 110.34 plus 67.59 plus 1.24 plus 6.60 plus 24.83. I have gotten 1353.92. This is 1353.93. What about the outputs?
711.72.
You have gotten
711.
711.72.
711.72.
711.72. Like that.
Yes.
Is it okay?
Yes.
Hello?
Yes, it's okay.
711.72. What we are getting here, when we are taking 711, because the VAT will be equal to output tax minus input tax, right? So if it is positive, it is payable. If it is negative in this aspect, it is refundable. So I think here should be payable, and here should be refundable. Here should be refundable. Here should be refundable. So in this case, it should be 711 minus 1353.93. And here we are going to be having
642.
What am I doing? This is more. Inputs are more than output, right? So we are supposed to be getting a refund. Sorry. So here should be refundable. And here we normally pay. So in this case, hapa napata 642.21. So the totals here should be 1353.93. Here I know you've got 1353.93. Have you understood?
Yes.
Now I will be able to prepare the question for restriction. Then I share with you maybe tomorrow or Tuesday. The question where we have to restrict, and then you have to remind me. So the questions, you have to do a lot of questions for VAT and deduction allowances as we move forward for practice. So let us tufanye ma practice kabisa, but ni kumbushe kesho ama on Tuesday ikiwa questions na utakuwa good to do your VAT. Be okay to do your VAT. Ni sawa? Is that in order?
Yes.
Hello?
Yes.
Good.